basis. Leslie is joining us today from her home in Canada. I personally wanted to thank Leslie for taking the time to be with us today. As we spoke earlier this morning, I learned that Leslie also has an 11 and 13-year-olds who are currently remote learning in the home, something that sounds very familiar to most, I'm sure. But to me, this was such a reminder how globally we are all being faced with unprecedented challenges, which always leaves me personally asking the question, what's next? So Leslie, no pressure, but we are all eager to hear your thoughts on what to expect next from our economy.
Well, thank you very much, Jennifer, for that kind introduction. And at that point, I will share my presentation here. So I am just going to keep it in this view. Hopefully the slide is big enough for everyone to see. So thank you very much for having me. And there will be time for questions at the end. So just to keep the technology clean, we'll keep those questions to the end. So light at the end of the tunnel is a very accurate description for where we are in the recovery from the COVID-19 pandemic. Now, right now, we're still in the tunnel. And really, it's very dark right now when we look at it from a health perspective, with the number of deaths setting new records yesterday, infections remaining elevated. And as a result of the rise in infections and necessary public health restrictions that have come in across much of the country, we did see the economy lose jobs in December. And even today, we did see jobless claims in the latest week rise in early January. So we do think it's likely to see more job losses in January as well. But our forecast is hopeful that, as the saying goes, we do think that it will be darkest before the dawn. And contrary to where we were a quarter ago, if I was presenting to you 3 or 4 months ago, we've really had encouraging developments on the vaccine front with multiple effective vaccine candidates, not just one. And in the US, inoculations, are underway. There's certainly some criticism that they haven't been fast enough, but as I sit here in Canada, I can tell you the US is faster than Canada. So really, we do see the light at the end of the tunnel, which we do think that vaccines, if it all goes well, will enable activity to really pick up in the US come the spring. And it did result in an upgrade to our forecast versus where we were in September. And in the chart here, I'm just a bit of a schematic to show that the path of the recovery really is dependent on the path of the virus, which in turn is really dependent on the availability of the vaccine. So we are dealing with a large degree of uncertainty on the outlook. Economists in the current environment, to a certain extent, have had to become epidemiologists, and where we think the disease is going, how quickly we think the vaccine will roll out, and when that will impact consumer behavior, when people will be able to get out and resume their previous activities. So the situation is very fluid. So, of course, as I said, in the short term, we've had the virus doing worse than we had expected. But on the plus side, we do see vaccine distribution leading to an uptick in growth in the second quarter of the year, which will lead to a stronger recovery in the latter part of this year. So, and I'll get into more details on the US, but first I am going to talk a little bit about the global economy. And based on the announcements we've seen today, as well as high frequency data, we do think Europe is likely to see a pullback in economic activity and a double dip recession in Europe. The chart on the right is a little dated in terms of, this is the Bloomberg consensus for Euro area real GDP, which is likely to be in contraction in the first quarter, just given the continued restrictions and decline in activity. We do think it will be relatively shallow, not as deep, certainly, as we saw in the spring, and likely most severe in countries where the lockdowns have been strictest, such as Ireland. Germany, which is Europe's biggest economy, is looking to see continued growth, and in part that's due to its heavy leverage to manufacturing. And that really has been one of the themes in this pandemic. In contrast to a typical recession where your goods sector firms or industry see the biggest downturns, this pandemic has been unique, of course, because it's actually been services that have been the hardest hit in this recession due to the necessity for social distancing. And in Europe, you see that it's the services, this is business sentiment, that has worsened the most since the second wave of the pandemic, whereas manufacturing is signaling growth. And manufacturing has really recovered much more strongly in this cycle. And, you know, when you think of manufacturing globally, of course, one of the countries that is the leader is China. And China was really the first in and first out in terms of the pandemic. China is an example of a successful response to the health crisis, though one that really took a level of government intervention that really few democratic countries would tolerate. But China's economy did fall steeply in the first quarter of the year, but bounced back just as quickly in the second quarter. So as a result, it's going to be one of the only countries in the global economy that will see growth as a whole for 2020, the year we just finished. Whereas most advanced economies are likely to see a decline, or on track to see a decline. The speed of the recovery also reflects, of course, its ability to marshal resources very quickly. But again, you know, not something that a lot of democracies could have achieved in terms of the control of the economy. Now, just to segue a little bit from the virus, but on a China theme closer to the US outlook, you may recall that 1 year ago, one of the biggest economic stories was the phase one trade deal with China, which set targets for Chinese purchases of US goods and a reduction in the trade deficit. So that target was always going to be difficult to achieve and, you know, really quite impossible now, particularly the way the pandemic has gone with such strong demand for consumer goods. So the green bars in this chart show you the actual trade deficit in 2020 and what it would have been if the trade deal, the phase one trade deal targets were achieved. So we do expect that trade issues with China will continue to be an issue in the new Biden administration. We'll continue to have some of the beefs with China that the previous administration did. And as the virus starts fading from view, this is likely to be a theme of increased importance. Now, turning to the US economy, this chart just shows real GDP growth over in recent years and the decline we've on track to see in 2020. Of course, the year is not entirely actual data yet, but it really masks what was a sharp decline in the first half of the year and a very sharp rebound. The US economy declined by about 10% in real terms in the first half of the year, and it's actually rebounded about 70% of those losses over the second half of the year, which is actually a lot better than we economists were thinking about 6 months ago. We expect the US will reattain its pre-crisis level of activity in the third quarter of 2021. Now, that's just getting back to the level of growth in Q4 2019. It's not making up for all the lost gains that we didn't see due to the pandemic. And in contrast to Europe, where we are talking about a double dip recession, in the US, we are expecting to see growth expectations. Growth expectations have fallen in as the virus has surged, but we are continuing to expect growth in the first quarter. These are just Bloomberg consensus for the fourth quarter and the first quarter, showing Canada as well. It's a very similar story in Canada as the United States, just for some context. Now, in terms of the virus surge, you know, one place we have seen that show up, as I mentioned, is in the labor market. And we did see jobs decline in December, and we do think they are on track for another small loss in February. But just to turn back on how the labor market has done, we do think they're going to take time to normalize. The unemployment rate has fallen quite dramatically from a peak of 14.8% in the spring, and we're now at 6.7%. But one thing we like to point out about the unemployment rate is that it really does, to a certain extent, it hides the full degree of joblessness in the economy, because so many people have dropped out of the labor force. And when someone's not looking for a job, they're not counted as being in the labor force, and so they're not counted as unemployed. And if you were to hold the labor force at February levels, the unemployment rate would really be more at the 8.9% level. So still quite elevated by either metric, quite elevated relative to where we were coming into the pandemic, which was at a very strong labor market with the unemployment rate at 3.5%. And one thing we're watching closely in terms of the labor market is impressive gains have been made since the spring, but more recently, and this reflects the second wave of the pandemic, progress has stalled a fair bit. And this graph is just showing sort of the millions of people who are out of work and different characteristics. The gray bar is temporary unemployment. And that's really where we saw the historic surge in unemployment. And a lot of the temporary layoffs people have come back to work. That 18 million is now down to 3 million in September. But where we haven't seen as much progress is sort of in regular unemployment. People who have either lost their job permanently or have entered the labor force and don't have a job. And that's really what's remained steady in recent months, in addition to people who aren't being counted as in the labor force but want a job. So that's something we'll be watching closely. These would be more the sort of standard recessionary type job losses. And in terms of who has lost work, of course, you've probably heard that the bulk of the job losses have been in leisure and hospitality jobs. In fact, as of December, 40% of jobs lost in the US have been in leisure and hospitality, which is disproportionate given the sector only accounts for 11% of employment. And even within the black bars that I've shown here are the sort of industries within leisure and hospitality. And of course, not surprisingly, you see the heaviest losses in terms of accommodation and arts, entertainment, and recreation. And then third being restaurants and bars is really, the heavy toll. It's not really been an even pandemic in terms of where the losses have been felt. And the flip side of the industry mix is, of course, it really has been workers at the lower end of the wage spectrum that have disproportionately lost jobs. So, of course, this meant individuals typically with the smallest cushions to bear a job loss, which is why the fiscal response of Washington, was really so important to ensure we didn't see more stress in the economy and people more severe outcomes there. And in terms of regionally, this chart is just to show, states across the US, I'm sure as you know, have taken different approaches to the public health restrictions. And we really have seen, states that had looser restrictions initially, places like Florida and Texas did see a lesser degree of job losses initially. So less of a hole to dig themselves out of. Of course, the other part of this chart that, I really should show alongside it is, of course, how they've done. We can't really divorce this from the outcome in the virus. And in terms of these typically also are areas that have seen heavier losses in terms of COVID and higher infection rates. Now, in terms, I mentioned the fiscal response being so critical, particularly given that lower income workers have borne the brunt of the pandemic. And one thing that's interesting is to look at the international comparison. And when we think back to the second quarter, even in Peter's remarks at the beginning, talking about Congress often being criticized for being deadlocked and partisan bickering. But I really do think that in the case of the pandemic's early days, that Congress needs to be applauded for passing the $2.3 trillion CARES Act relatively swiftly in late March, when you think it really came only a couple of weeks after, the pandemic was declared. And it was larger than the financial assistance that was passed over the entire course of the global financial crisis. And, that was achieved in 2 weeks. And what we're showing in the chart here is really Canada and the US, in terms of advanced economies, led the way in the second quarter with providing the most income assistance to households. And I think that has really helped in enabling consumer spending to jump back relatively quickly and to sort of forestall greater pain amongst households. So you see in the green bar, that's how much the economy declined in the second quarter. And in fact, income grew thanks to the generosity of governments. Now, of course, since then, the US has passed more fiscal assistance, and I'll get into that in a moment. But I really think that, particularly in the US, that Congress learned the lessons of the global financial crisis, which was to act quickly. And if you're going to provide assistance, act quickly and decisively to stave off more prolonged pain, particularly like we saw in the global financial crisis. So just to show the income supports in another way, the dark green bar is typical personal income, and personal income in the US also includes income from sole proprietorship, so also, small businesses, is you see that there was a drop in the second quarter with all the restrictions, but with the pandemic income supports provided, personal income was actually able to grow. Now, the support did diminish as the year went on, and you can see that income was recovering. Now, of course, in the first quarter, we've had that recent $900 billion fiscal package, which is going to further help, and checks going out to many qualifying Americans, which is going to boost income more in the first quarter. And we now have the incoming Biden administration talking about $2,000 checks. So just to sort of show an estimate of how much further that would boost income. And we are supposed to hear from President-elect Biden tonight in terms of what he is considering proposing in terms of the next round of coronavirus pandemic assistance. Now, so consumers have received a fair amount of income support, and this is really helping to put a floor under consumer spending, but not only the government income support measures, but also for consumers who do have equity market investments. There have been healthy gains since in the equity market, showing the 5-year bond yield here has come down. So of course, debt has become more affordable for many households. House prices have gone up, so households do get a bit of a wealth effect there. So we do expect that these sort of wealth and income growth will help support consumer spending as the economy is able to reopen once the inoculation campaign gets further underway. Now, in terms of the New England economy, these low interest rates, and in fact, across the United States, and demand for space. We have really seen a lot of people, as we're all shut up in our homes for months at a time, people want a bit more space, maybe to move out of more dense urban centers. And we have seen house prices accelerate notably. This is just comparing house price inflation from where we were a year ago in November 2019 to the latest data in November 2020. And you can see the nation as a whole accelerated a fair bit. And I think in aggregate, New England has seen an even sharper acceleration than the country as a whole. Of course, Connecticut stands out as, you get a lot of residents leaving New York City, of course, in the early days, one of the most impacted areas of the virus, but also the smaller New England states, Vermont, New Hampshire, Maine. You do get a bit more demand from out-of-states buyers in these regions, which have boosted prices. Looking ahead in terms of the housing market, we do expect price gains to slow in the coming quarters as affordability constraints, higher prices have made many regions a lot less affordable, and that we do expect that to rein in price growth in the coming quarters. And at this point, I'd just say a few more words about the New England economy. TD Bank, our footprint is the Eastern Seaboard, and we do forecast GDP for all the states along the Eastern Seaboard. So you see here, New England, tough year for many states in terms of the contraction in GDP, a little bit more so than the nation as a whole, really in part because many states in the region took a very proactive approach to containment. The virus's surge in Massachusetts, Connecticut, and Rhode Island have been relatively strong in recent months. We do expect a firmer recovery to take shape in the next year. However, a strong exposure to tourism activities for some of the region's smaller states will become more of a positive as the vaccine is rolled out and people are able to start traveling again. So overall for the region for next year, we're expecting a rebound of 3.9%, a little bit below the national average, but New England with its older population is typically has a slower pace of growth than many other regions of the country. Massachusetts is expected to be a growth leader, which is frequently the case. Now, in addition to the course of the virus, which is, of course, the biggest uncertainty on the outlook, given we are seeing new variants, of course, we don't know if these new variants will not respond or not be curtailed by the vaccine. That's an uncertainty in our outlook. But another uncertainty in the outlook, as I mentioned, comes from fiscal policy. Now that the Biden administration has, a razor-thin majority in the Senate, we do expect that it will be able to, sorry, just lost my train of thought, implement more spending, which could see growth be much stronger than our current forecast over the next couple of years. In fact, some estimates, what we're showing in the chart here with the lines is during the election campaign, the Biden camp outlined about $3.5 trillion in spending, which they proposed to partially fund with around $1.4 trillion in tax increases. So of course it remains to be seen what they can pass, but if they were able to implement their full agenda, we do estimate that growth could be significantly higher both this year and even more so next year, given some lags in terms of, sorry, I'm going to try to switch to slideshow view. No, that's not going to work. Sorry about that, everyone. But we're not sure that even though the Biden administration and the Democrats have their razor-thin majority in the Senate, that they will be able to implement their full agenda. Of course, the Democratic Party is not necessarily in complete agreement across the spectrum, and moderate Democrats in the Senate are likely to have a decent amount of weight in terms of what can actually be passed. So we would consider these lines of growth sort of upper estimates if Biden is able to implement its full agenda. But, we'll see what they are proposing tonight in terms of further coronavirus aid. So really we have this tension in the forecast that we could see some near-term downgrades to growth given the continued spread of the virus, but that we could see stronger growth in the coming quarters, given likely further assistance from Washington. Now, of course, all of this government largesse does have a bill. It's exacted a toll on government debt burdens, not just in the United States, but around the world. In the US, we've now eclipsed the level of debt as a share of our economy that we saw after the Second World War. And that's really the case globally. Emerging markets, as represented by the green lines, are heavier indebted. However, no one seems to be talking about austerity or belt tightening coming out of this crisis, which is what we did hear a lot of, particularly in Europe, and to a lesser extent, the United States in the early years of the Obama administration, sort of the kind of austerity to get budgets back in line. And this time around, the IMF is very much saying that countries should continue to spend more and not cut fiscal support too early. The IMF have said that austerity is not necessary immediately, and this is in part because they saw the toll that exacted coming out of the financial crisis, when many countries, particularly in Europe, tried to balance their books too quickly after the crisis, and it did become a big weight on economic growth. And in fact, the IMF pointed out that too rapid austerity, it may be successful in reducing a country's debt burden, but it can also contribute to social unrest, populism, and political polarization. And also pointing out, the IMF points out that with today's low interest rates, countries can benefit by keeping debt servicing costs relatively low, and that there are a lot of benefits, particularly from infrastructure-related government spending, which has been a stated priority of the Biden campaign, is quite high in a recessionary times. Now, in terms of we do expect the pandemic, I think, as I mentioned earlier, to have many legacies. The first being, as I just discussed, elevated government debt levels. We do think that central banks are likely to keep interest rates low for a relatively longer period of time. Also, of course, as I alluded to, for New England and the US as a whole, shifts for demand in real estate. This is a big question mark, to what extent the move away from dense urban centers is permanent, or whether once we get the vaccine, that shift is reduced. We do have high household savings currently in the United States and many other advanced economies, and how those savings could be unleashed in consumer spending going forward. Labor market scarring. Now, when economists talk about labor market scarring, what that means, basically it's long-term unemployment. And some of the sectors that have been hardest hit by the pandemic, I'm thinking about arts, entertainment, recreation, the sorts of activities that are really going to be the last to come back, things like large rock concerts or, live theater, things that involve people being in close proximity to one another for prolonged periods of time. People that work on those sectors, will they be able to find work in another sector in the short term, or do we have this sort of longer term unemployed group of people that, then once their sectors do start coming back, how easy is it for them to be reemployed in those sectors? So that can cause financial stress for many households. And the final one we have here, industrial policy usurping free trade. We really did see a move away from more free trade concepts with the Trump administration. And I think, given the challenges in the early stages of the pandemic, we saw with things like availability of personal protective equipment, a lot of countries, starting to focus a bit more on potentially should countries be manufacturing more of these types of materials domestically, and more national industrial policy to foster these. That could be there's a question mark on that one. It remains to be seen how much of that we're expecting. But at that point, so I would say we continue to focus on the light at the end of the tunnel. Of course, there are upside and downside risks to that. Upside risk largely being, further assistance from a Democratic administration in Washington, and downside risk, the biggest downside risk, of course, would be further virus mutation that, sends scientists back to having to reformulate the vaccine and delaying the rollout. That, of course, is, the biggest downside risk in the near term. Just to flag our websites, you'll recall that chart I showed, which was the graph of our state economic outlook. We do publish quarterly state economic forecasts and national level forecasts. So if you're interested, I would encourage you to check it out. It is publicly available on our website. You don't need a subscription or anything to take a look at that. So at this point, I would like to open it up to questions. I believe Peter mentioned to me to ask questions in the chat. So
yes. So Leslie,
I can see now that I'm not.
Yeah, we have a few on the chat right now. But by the way, let me just, sorry to interrupt. Great job, by the way. It was a very thorough talk, and I really appreciate how well you covered all the elements. And but we do have a few questions right now for you.
Great.
Okay. Well, two of them are from me. Because that's at the top of the list. I'm going to give you those first. What is, with all these stimulus payments, first of all, we had 2.3 trillion in the spring, and then we have another, I think about $1 trillion or so that just went out. And, we already had a national debt of, I think, around, I'm going to say it was around 15 or 16 trillion. This adds another few trillion onto that, and I think there's more to come. Isn't that having a long-term negative effect on the economy? And what is the result of all this? We're spending money we don't have.
Yeah, and I think it will become increasingly a concern if we ever get to a place where interest rates start rising. But I think we need to distinguish between one-time spending, which certainly affects the debt in sort of a level shift, versus where we were prior to the pandemic, which was with a primary budget deficit, which is adding to the debt, as you go forward. The outgoing administration passed tax cuts and spending increases that I wrote about this 2 years ago, that expanded the deficits in what was arguably a very strong economy. You know, unemployment going to 3.5%, and we had expanding deficits. So I think I would distinguish that, yes, we've had these massive, I mean, we've had a once in a lifetime public health shock. So in terms of that temporary spending, you know, assistance to businesses through the PPP program, all of that, very necessary, but it's done. It adds to the debt one time, and, you know, the country will have to pay that off. I think the larger concern is, you know, as we come out of the pandemic, will be, you know, the U.S. needs to fix its what we call a primary deficit. The fact that, you know, ongoing spending and ongoing revenues are not matching, and particularly as baby boomers move into retirement and collect Social Security, that's a major concern. And I think less so in the immediate term. But I think one of the things of this administration will be that there will need to be tax increases, you know, rolling back of much of the previous administration's Tax Cuts and Jobs Act to start to really deal with that primary budgetary deficit. But again, I would say with very low interest rates, the burden of the debt in the United States is low. The Congressional Budget Office continually has to downgrade its, you know, with interest rates remaining low, its sort of burden of the debt, which is why people like the IMF encourage countries to spend to offset the pandemic. But it's really sort of a long-winded answer to say, you know, I worry less about the one-time spending and more about, you know, the situation the US and other countries were in prior to this, which was they, you know, not getting the house in order during good times.
Okay, good answer. Wow. And by the way, before I ask you any more questions, to everyone out there, please type your questions into the chat and we'll try to get to as many as we can. We do have some time constraints, but we're going to do what we can. Next is, again for me, sorry, why haven't the reduced incomes, that sort of that portion of the economy that's in the service economy and so forth, but that's been most affected, why haven't those reduced incomes had a more significant effect on the GDP and the numbers going forward? It seems like we're right back to normal growth, but all these people were presumably without a lot of income, and those stimulus checks, let's face it, it didn't make up for most of that.
Yeah, well, I think there's two parts to that. I mean, in addition to the one-time stimulus checks people got in the spring, or I guess 2 times, we also had very generous unemployment benefits, at least through the end of July. You know, people on unemployment were getting an extra $600 per, you know, per week. That did end. There was some measures that Trump put in under executive order to expand that. And now under the $900 billion passed at the end of the year, people will get $300 a week in addition to their state benefits. So that's gone a long way. The other side of that is because job losses have been more concentrated at lower wage jobs, it's less of an income hit overall at the aggregate level when those jobs are lost. So, you know, but I do credit fiscal policy, and indeed not only those unemployment measures and the one-time checks, but the PPP programs that would have enabled businesses to keep their payrolls going more so than they otherwise would have. So I think that really has been, you know, a success story that once things opened up, I mean, if I were to look back, I should maybe add this to my deck in the future of where we thought the forecast would be back in, say, June or July. The economy has really rebounded much more strongly than we expected at that time.
Oh, okay. Good answer. Thank you. All right. Next question. Okay, this is from Sanjay. Sanjay asks, has the proposed tax increase factored into the projected growth rates 22 to 24?
So short answer is no. You know, our forecast, when we did our last forecast, we knew who the president was going to be. We didn't know the makeup of Congress because you still had those Georgia Senate elections to come. So we haven't included tax hikes yet. You know, one thing I think, we didn't have a lot of time to analyze the impact of the Trump tax cuts, but I think, you know, what a lot of academics have taken away from it is that, you know, the impacts tend to be less than advertised in advance. We didn't see those tax cuts came in a relatively strong economy, and we didn't see the sustained improvement in investment that would have been predicted by a lot of the proponents in advance. So, we'll know more as we hear from the administration, and as we know more about what's likely, those of course will be incorporated into our forecast. But I think what you might be hearing from me is a little bit of skepticism that the tax cuts that the Biden campaign proposed would have a huge negative impact on the economy.
Okay, good. All right, next question is from Dave Richmond, and he's asking about vacancy rates in office space. So I think the concern is that what's going to happen with the commercial real estate market, and could that have some sort of disastrous effect in the future on that portion of the marketplace, and how much would that affect the greater economy?
Yeah, certainly commercial real estate is an area of concern in our outlook, and we do have weakness. We've published a couple of papers on that on our website, not myself personally, but both on the office and retail space. And much like I alluded to in terms of the housing market with people moving out of denser urban centers, this is a key concern, particularly for office space. Are we all going to continue to work a portion, of our time from home now that we've all gotten so used to it? So we do expect some softness in commercial real estate over the coming quarters. Typically in a recession, investment in what, economic statistics call structures. So commercial real estate is typically one of the slowest areas to come back after any recession, just because those kind of decisions to invest are so long-lived that, businesses really need to be confident before they invest in those areas. But yeah, no, that is an area that we're watching closely and is an area of weakness. Retail also, the shift in retail has been ongoing for a long time, and the move to online shopping and weakness in terms of retail, but the sector, we hadn't been adding a lot of new retail space, so we haven't seen vacancies have been kept under control. But it's an area of high uncertainty, and it is one that we have written. So I would encourage you to check out the website and read a little bit more on that.
Okay, thank you. And next is is there any forecast that you have for small business valuations versus larger businesses? Or, small business valuations versus public markets?
Yeah, that's a great question. I think that's a bit, small businesses are across, wide, as wide sectors of the economy. So I think it would be very tough to generalize in terms of smaller business valuations versus others. So yeah, I'm sorry, I can't.
Okay, that's all right.
Provide
That's
much insight there. That is.
I think it depends on the business. You're right. It's hard.
Yeah,
it's okay. And the next one comes from Jordan Richmond, and he says, we have been talking about the growth to value rotation in equities for a while now, and it hasn't moved as fast as we would have thought. Do we still expect that rotation to happen in Q1, or are we projecting it further down the road now? Now, in order to answer that, you're going to have to tell us what a rotation is, because I don't understand that personally. And I was an economics major, so go ahead.
So I may actually plead the fifth on this one. There's some initials I'm missing after my name to sort of, I'm not a stock picker, or I don't give, equity strategy advice. There's certain designations one needs to have before, often when I present to more wealth audiences, wealth management audiences, I present with a market strategist who would talk more about that. So yeah, I can't really comment on growth to value rotation. I mean, I do understand what the question is asking, but it's not something that we in economics, we don't forecast the stock market.
Okay, great. One last question. Thank you for that answer. And I understand that's not your area. Okay, so from Doug Kerr, he asks, artificially low interest rates have increased bond prices and will likely result in big losses when rates normalize. Once unemployment goes down, won't inflation come roaring back and cause major havoc in stock and bond markets? So again, for the stock market, but.
Yeah, I mean, I think the key question in there is, what is normal for interest rates? I mean, yes, and in fact, recently, since the Georgia Senate elections, we have seen Treasury yields come up as markets start to price in greater fiscal stimulus and perhaps slightly higher inflation. And that is an active area of research in our department in terms of, with this fiscal stimulus, what are the chances, we do see more inflation. One thing I would point out is, in recent years, prior to the pandemic, we had a very strong economy with unemployment, reaching historic lows, and the Fed was unable to achieve its 2% inflation target. So I don't think it's something that economists have, worked out a perfect mathematical relationship between unemployment and inflation. We have these theoretical models we like to talk about, but in the last expansion, they weren't, working so well. The Fed's supposed to be targeting 2% inflation and couldn't even get that in a strong economy. So, frankly, the risks of an economy being in deflation, like Japan has been in the past, decades, are worse than inflation if we see stronger inflation and the Fed raises interest rates. But I think the reality is, so yes, the risk that rates rise more rapidly than we expect, certainly in bond yields, is a risk. But I think what we've learned over the past 10 years is that we are in a what a normal rise in interest rates is likely different than it was, 20 years ago. We are in a lower interest rate environment for a longer period of time.
Okay, great. And thank you. Good answer. And to me, I would think that with all the debt we have, they're going to be loath to raise interest rates because that's going to increase the debt, right? And to make it that much more difficult to pay.
Yeah, and I mean, interest yields on treasury yields were low prior to the pandemic, and a lot of that speaks to sort of the global investor appetite for safe assets. I mean, clearly the market was willing to buy all these treasury, or had an appetite to buy all these treasuries at very low yields, which, there's a supply and a demand situation going on there, that clearly the appetite for debt in the market is very high.
Mm-hmm.
And I think, there's a lot of academics who, talk about, it's an aging population, pensions, have a high appetite for debt assets. So it's, of course, we're watching for the risks of higher inflation and higher yields, but, those seemed pretty slow to materialize in a hot economy prior to the pandemic.
Okay, good. And I'm going to, first of all, there's a question about a web link to get the reports regarding commercial real estate. Is that something we can get?
Sure. Should I send it to Jennifer and she can share with the group?
That would be fantastic. Thank you. And I'm going to do the final question, actually, which is your thoughts on the dollar, the value of the dollar. What do you see coming up in the future?
Well, we've long had this forecast. In recent years, the U.S. dollar has been quite strong. Now, of course, that's speaking against a basket of currencies. So we've long had this forecast, and that's partially reflecting the U.S. economy's outperformance in recent years relative to the globe. And our forecast has long called for sort of a more normalization as other parts of the world grow more rapidly, with sort of a my internet connection is unstable. I hope you guys can still hear me. To sort of a longer term decline. Yeah, in the U.S., longer term depreciation, but nothing major. So, obviously depends on which currency pair you're talking about, but sort of a call for a modestly weaker U.S. dollar over the coming quarters. And again, I could, on our website, all of our forecasts are public. We do have, specific currency pair forecasts available on our website.
Okay, great. I appreciate that. Well, listen, you've done a wonderful job, and I know that I'm speaking for everyone that's on the call today. And by the way, it's our record turnout for a NEBBA Zoom meeting. So, and that's probably mostly thanks to you. And I appreciate that. And you've done a great job. And so I just want to say to everyone at NEBBA, stay tuned for some information on upcoming meetings. and we appreciate your membership. And if you're not a member now, please sign up. It's not expensive. Company membership is only $125. And if you're a second person at a company, it's only $50. So it's the lowest priced membership around. You'll learn a lot at NEBBA, and carrying that NEBBA logo as you walk around throughout the day and do your business is really valuable. So thank you to everyone. Thank you, Leslie. Thank you to our board and everyone that helps out and everyone that helped out today with this call. Thank you so much, and enjoy the rest of your day, everyone, and have a happy and successful 2021. Okay, everybody.
Thank you.
Thank you, Peter.
Okay.